All right, well, thank you very much for having me today, and I just want to say to everybody, thank you for participating and taking some time out of your day to listen to my presentation. I'm going to talk about the art of trading today, and specifically the forgiving spread. Um, the art of trading, to me, is all about really learning how to finesse your way through the markets and understand exactly what types of choices you need to make to be successful. The forgiving spread is one component of the entire art of trading, and that's what I want to focus on today. So just real quick, my trading experience, as he said, is 25 plus years. I spent 26 years as a senior executive with a Fortune 500 company, ran multiple divisions for them, and during that time I traded as a hobby and really enjoyed it as a hobby. It was a lot of fun. It was fun for me to kind of dissect what worked and what didn't work in the markets. I traded futures, I traded commodities, and I've traded options, and for the past 10 years or so I've traded exclusively options and really identified ways to continue to improve the success rate of options trading. Today I spend my days as a teacher. I do teach option trading on a daily basis. I have a large number of subscribers who listen in as I analyze positions in real-time market conditions and send that out as a recording so that they can continue to listen to that and use that as their ongoing education. Also, I have a book coming out in 2 weeks. It's the first of 3 books that we will be releasing in the next few months. If you have an interest in buying the book, just send me an email to markd@optionsmoneymaker.com, and we will certainly send you a link then as soon as the book is released. But 2 weeks from now, the book will be out. It's called The Art of Trading More Profits in Less Time, and it's all focused on cash flow, retirement security, financial liberation, and how to achieve that. I also spend some time as a personal development coach. Outside of the financial arena, outside of trading, there are people who just need some guidance through the course of a year in navigating perhaps job choices, job promotions, life choices, and people hire coaches throughout their life. They hire golf coaches, they hire personal fitness coaches, they hire marriage counselors, they hire all sorts of coaches and counselors, and I provide a fair amount of that on a personal basis also. Option strategies. At Options Moneymaker, we continue to refine option strategies and try to create strategies that are available to any level of trader. As long as someone understands the basic characteristics of options, then they can avail themselves of most of the strategies that we teach, strategies that we cover in my book coming out, and strategies that we're going to be talking about today. I put a preference on non-directional strategies, or at least strategies that have a forgiveness factor built into them, which I'm going to be talking about today. And we like to make them relatively simple, and we like to hone our skills at identifying strategies that have a high win rate to them. So I just want to pause for a second and talk about the art of trading, what causes trading anxiety. It is something that is a reality for most traders, and it is something that most traders do not understand how to get around, how to avoid. And I'm going to tell you that based on my experience with working with several hundred traders over the last several years, that the capital commitment that you have in a trade is generally the #1 thing that drives your anxiety. You feel really good about dumping a bunch of capital in when you open the position, and the minute that position doesn't start working out the way you thought it would, then you have no idea what to do with that strategy, and you have no understanding of how to properly manage or adjust that strategy. And all of that collectively is what tends to drive a fair degree of anxiety in people. And what I want to share with you today is one simple strategy that can actually help you not only make more money in less time, but eliminate or dramatically reduce the amount of anxiety that you feel. So the topic for today is all about keeping your trading simple. We don't need to make our trading overly complex. We don't need to make it complicated in order to be successful. And what I'm going to propose to you today is the concept of a single strategy, single position type trading. The single strategy is all about getting very intimate with one particular strategy. Now I'm going to propose a particular strategy to you today, and you could choose to use that for the single strategy approach, or you might have another strategy that you prefer. But just stay with the concept of a single strategy approach to trading and think about how if you traded that over 6 months or 12 months and you really started to understand how it responds to each variance in the market, how much better you would really understand the depth of that strategy and what it can do for you. So what I want to share with you is a single strategy approach, single position approach, what can happen when you're very focused on that single strategy in understanding it, and patient, and how to basically trade for more profits in less time. So the single strategy that I want to propose to you here is a calendar spread strategy. Now, we at Options Moneymaker did not create the calendar spread strategy. It's a widely known and commonly used strategy. However, I've found in my discussions with traders that they don't truly understand the dynamics of the calendar spread, how to properly construct it, and the forgiveness factor that's built into a calendar spread. And those are important elements in really understanding and being successful with your trading. A calendar spread is constructed by buying to open one option and selling to open another option. So you buy to open an option, sell to open an option, you end up with two option legs. It's a two-legged option spread position. You're buying to open an expiration that is further time than the one that you sell to open. And you're going to choose the strikes that you open based on the delta value of the long leg. Now I'm going to give you an example of that. So that's just kind of a preview of how you construct the position, but I'm going to give you a specific example. Calendar spreads have a forgiveness factor built in. They actually can win even when the market or the price of your underlying equity moves against your position, and I'll show you how. Here's an example of a calendar spread trade. Now, I was looking at this calendar spread trade 2 days ago. NDX was trading at 41.87. And I opened this calendar spread trade on NDX. Okay, this is the NASDAQ 100 index. We prefer trading indexes, although we trade a small group of stocks also. But the indexes are an outstanding way for you to minimize the amount of trading time that you invest in researching a whole bunch of different equities or researching a bunch of different stocks. And we trade the same indexes over and over again. So we bought to open the November week 4 NDX 4150 put. That was 37 points out of the money. We paid $25.15 for that. At the time that we opened it, it had a delta value of 0.35. So I'll come back and talk about that in just a minute. We sell to open the November week 3 NDX 4150, and we took in a credit of $17.10 for that. Now, a calendar spread is constructed using two different expirations, and the expiration of the long is always further out than the expiration of the short, the leg that we sell. But a calendar spread is constructed using the same strikes for both legs. And the way we choose the strikes is using delta as our guidance. We typically open a calendar spread with a delta value of 0.30 to 0.35, somewhere in that range. And one of the reasons we use delta to determine and place our strikes is because it happens to allow us to naturally take into account volatility. When volatility is higher, then we are going to be placing our strikes further out of the money. When volatility is lower, we tend to pull those strikes in closer to us. And we're going to tend to find that the net debit for our spread is relatively consistent. It's going to be in a range. And the amount of premium that we receive for the short leg that we sell to open is also going to be relatively consistent. So we opened our trade, first of all identifying that we wanted to buy to open week 4, sell to open week 3, and we sold to open week 3 because it had a little over a week and a half remaining to expiration. And we want that very rapid time value decay in the short leg. We then identify on our options chain the delta, and we look for something in the delta of 0.30 to 0.35, so 30 to 35 deltas. Now this trade is set up to benefit from a move down, but it also has forgiveness factor if NDX moves up instead. So we had a view that NDX had a bias to move lower while it was trading at 41.87, that we thought it could potentially move lower. Instead, so we set up a put spread to take advantage of that. If in fact the NDX did move higher instead, then we have an opportunity to still perhaps take a profit. So what specifically is the forgiveness factor? Well, it's when the price of the underlying equity moves against your position and you still could possibly make a profit or at a minimum break even on the position. If I can break even on a trade that I chose as a directional trade and I was wrong on my assessment, the market moved against me, if I can get out of that trade at break even, I consider that to be a win. If I can still make a profit on that trade even though the index moved against me, well, that's an even bigger win. So we like to work with, at Options Moneymaker, we like to work with strategies that offer us a non-directional approach to trading where we don't really care which direction it moves. Or if we are adopting a directional approach, we have some forgiveness built in so that we don't immediately get smacked down if we were wrong on the direction. So let's take a look at what could possibly happen on this position if it moved up instead of moved down, which it was designed to. Well, when we opened the position, the strikes were 37 points out of the money. So if NDX moved higher instead, then obviously our short strike, our short 41.50 strike is going to be further out of the money, and at expiration it's going to expire worthless, and we're going to keep the $17.10 of credit as a profit. Now the forgiveness factor means that I could afford to lose $17.10 on the long leg and still get out of this trade overall at break even. So when I'm setting up my position, I can estimate how far the index could possibly move, and I could still exit out for an overall break even. And the way we estimate that is we need two numbers. We need to know how much the position can afford to lose, and we need to know the delta. And so if we knew that we took a profit of 17.10 on the short leg, and we could afford to lose 17.10 on the long leg, we can take 17.10 and divide it by the delta of 0.35. So 17.10 divided by 0.35 equals 48.85. That 48.85 is telling you that the index could move up $48.85 based on the delta, because the delta is a rate of change in the value of the option relative to each $1 change in the underlying equity. It can move up 48.85, and you could still possibly get out of this entire position. Point move against your position actually has the opportunity to be closed for an overall profit. So the calendar spread has a lot of flexibility to it. It has the forgiveness factor built in. If I'm right on the direction, I win. If the index just holds firm at the current price, I win through decaying time value on the short. And if the index moves higher, but short of $48 higher, I still have the potential of actually winning on this trade. Now, here's the really cool thing about the calendar spread. And this is a approach that we use every single week at Options Moneymaker. The calendar spread can be used to create a true non-directional strategy. And you do that by opening both a call calendar spread and a put calendar spread at the same time. When you open a call calendar spread, it has a bias to the upside. When you open a put calendar spread, that has a bias to the downside. And because we open both of them, we don't really care which direction the index moves. This right away eliminates the need to assess the directional bias. Now, one of the things that I think people stumble with a lot is charting. I think as people are coming to trading and learning how to trade, they focus on strategies, they start to try to look at charts, but they don't really understand how to read a chart. They don't understand the technical indicators, which indicators to use, which service to use. So charting by itself, although I think it's an important factor in trading, it becomes one of the more complex learning curves as you are trying to get up to speed in trading. This approach eliminates the need to assess the directional bias, and so therefore you can put a trade on at any time. And once you put the trade on, you don't really care which direction it moves. You have a profit potential regardless of which direction it may move. One side of the trade wins on the move, meaning if you put this trade on and the index moved higher, the call spread is going to win on the move higher. And the other side of the trade benefits from the forgiveness factor. So if you do have, for example, going back to our 48-point move on our put spread, if you had a 48-point move higher, you could break even on the put spread and you would make money on the call spread. This type of trading is what we call the market tamer. This is a non-directional strategy. You can put it on at any time. You don't need to pay attention to a chart. Okay? Now, somebody asked a minute ago if the NDX was a cash-settled index, and the answer to that is yes. We trade SPX, we trade NDX, and we trade RUT, and they are cash-settled indexes. So let's take a look at a market tamer, having put a market tamer together. Basically, what we did was we added a call calendar spread to the put calendar spread we had already created. So our put calendar spread, as a reminder, was buying to open November week 4 and selling to open November week 3. 41.50 on the puts. We chose those strikes because of the delta. Now we want to have a market tamer in place, and so what we're going to do is add a call calendar spread. And the first thing we do is we go to our options chain and we find what strikes would work for us with a delta value that is reasonably similar to the delta that we opened on the long put. We want our long call and our long put deltas to be reasonably similar. So in this case, we chose the 42.25 calls because the delta was 0.34. Now, when I say reasonably similar, I gave you a range before. We typically open in a range between 30 and 35 deltas. But what I'm doing is I'm looking at the options chain and I'm looking for the strikes on the call and the put side in that 30 to 35 delta range, where I can marry together a long call and a long put and have reasonably similar deltas. So I don't want to have a delta of 35 on the long put and have 30 deltas on the long call. I'm trying to get them as reasonably close as possible. We're going to use the same expiration on the long and the short as we used on the puts. So now what we end up with is a four-legged market tamer position, and we are in the 42.25 calls and the 41.50 puts. You can see here what the debits and credits are on each of the four legs. The total net risk of this trade, combining and netting together all four legs, the two long debits and the two short credits, is $14.65. The debits, the long legs, cost us $43.75, but the short legs brought in $29.10 of credit. That relationship of the amount of credit on the shorts relative to the total investment risk on the longs is critical in the proper construction of a market tamer. We typically want the amount of credit on the shorts to be somewhere around double the total investment risk. It's not always going to be that. Sometimes it might be 80% higher instead of double. But we want to have a credit amount that is significantly greater than the total risk on the position. Now, this market tamer position, this four-legged, non-directional market tamer position, can be profitable if NDX moves up, if it moves down, or if it remains flat near the current price. Time decay on the short legs, on the short put and short call, those legs that we sold to open, is the primary driver of being able to close the entire four-legged position for an overall profit. Using weekly expirations when you're using these indexes is an ideal way to trade this type of a strategy. The weekly expirations offer you an opportunity to get into and out of trades almost every week. Now, it's not quite that cut and dry. Sometimes you end up managing a position, adjusting a position, and it may take you longer than a week to get out of it. But basically, you're leveraging the opportunity from those weekly expirations, and you're able to open trades, close trades, roll your capital into a new trade. Now, let's evaluate what can happen to this market tamer position now that we have all four legs in play. If the price of NDX remains between 41.50, which are the put strikes, and 42.25, which are the call strikes, if it remains in that zone until expiration, that's what we call the sweet spot. The sweet spot is that space between the put strikes and the call strikes. And if NDX were to remain in that sweet spot until expiration of the two short legs, which would be November week 3, which is the monthly expiration, then here's what could possibly happen. The short put would expire worthless because it's out of the money. It would have no value if it's out of the money. An option only has intrinsic value at expiration. Time value has decayed away, and the intrinsic value is equal to the amount it is in the money. So if the short put is out of the money, it would have no intrinsic value and it would have no time value. And so the credit that we took originally of 1710 would turn into profit for us. Now, if we're inside that sweet spot, it means that the short call is also out of the money, and the profit on that would be $12 because we took in a credit of 12, so we would allow that short call to expire and we'd have a profit of $12. So here we have a total profit of $29.10. Okay, $29.10. Looking good so far. Now the long call and long put there's a reality on the long call and long put that they will have some amount of diminished value, and we call that slippage. We call that slippage when the amount, the value on the long call and long put netted together is a negative number. Like if we only had those two legs and we closed them out, we would lose money. Slippage occurs through time decay because as you put this position on, we're benefiting from the very rapid time value decay in the short legs, but we also have to be practical and recognize that we have time value decay on the long call and the long put. Slippage can also occur by changes in volatility. Volatility decreases and you're going to have an increased amount of slippage because it depresses the overall value of options. So time decay and volatility changes will influence the amount of slippage. Now, we've been trading this strategy for several years, and my experience is that the amount of slippage that you have on these positions is rarely, but sometimes, rarely as much as 50% of the value of those long legs. It can occur, but it just doesn't occur very often. So for the purpose of our example here and wanting to emphasize the way these trades can play out, I'm going to assume that we have an extreme amount of slippage. Like we lost 50% of the value of those two long legs. That means we would have a loss of $21.87. $21.87. We're netting that loss against $29.10 of profit. And so we end up with an overall profit of $7.22. Now that $7.22, we're out of all four legs. We've closed all four legs. We have all of our capital back. We have a profit of $7.22. We didn't really care that we lost $21 on the longs because we made more than that on the shorts. $7.22 is profit against a total risk of $14.65. That gives us a 49% return holding this position for under 2 weeks. So when we talk about a 49% return in under 2 weeks, I get excited, but in my experience with trading these, I realize it's nice, but it's not practical. It's not practical to achieve on a regular basis. And so my counsel is don't be greedy and don't hold what we refer to as unnecessary risk. Unnecessary risk is that risk that is something you're generally blinded to. You may look at this trade and you still have 4 days to go to expiration, and let's say there's $10 of time value that will decay away in the next 4 days. Well, you're inclined to hold that position and wait for that $10 of time value to decay so that you can take yourself out for a much bigger profit. That's always exciting when you can do that. But the problem with that is you don't recognize at the moment that you see the opportunity, you don't recognize the risk, and it's unnecessary risk. Our sweet spot in terms of exiting out of these positions is typically in a 10 to 20% profit range. We like to exit somewhere between a 10 to 20% return. I want to back up here just for a minute and let's take a look at our cost basis on the total position. $14.65. If we wanted to have a 10% return on this trade, we're looking for $1.46 of profit. If we're looking for a 20% return, we're looking for about $2.90. Let's say $3 of profit. So when we set the trade up, and we set it up with $29.10 of time value that we knew was going to decay away in the next week and a half, we only need $3 of that to get better than 20% return. So if we allocate $3 of that $29 of time value to achieve our 20% profit, that tells me that we have $26 of time value remaining in the position, to compensate for slippage on the longs, and to leave some opportunity on the table and just exit out of the position. So we need a fraction of the total amount of time value decay available to hit a really nice profit target, 10 to 20%. 49% obviously is better, but I don't want to hold unnecessary risk. Now the unnecessary risk is that the longer you hold, the greater the amount of potential slippage on the long legs. Those long legs are working against you the longer you hold them. They are decaying in time value, and if you happen to hit a period where there was decreasing volatility, then you're actually going to see a much more dramatic increase in the amount of slippage on those long legs. So if you can exit out of this position for somewhere between 10 to 20%, and then immediately redeploy your capital into a new position and set yourself up for another 10 to 20% trade, that is preferable than trying to hold on to the position you have. I'm going to back up one last time here and talk about the sweet spot. This is a 75-point sweet spot, 41.50 to 42.25. Well, we could possibly be, the NDX could possibly have moved up, let's say, to 42.15, 42.20. We are still inside the sweet spot. There would still be a significant amount of time value remaining in the shorts that you might be tempted to just hold on to and wait until it decays away. But if I had a 10 to 20% return, I would grab the 10 to 20% return at that point, and I would then redeploy into a new position, but I would center my position again. And instead of being only 5 or 10 points away from being outside the sweet spot, I would recenter the position, be right back into a new position, maybe even still using the same expirations, but then the NDX would have to move more substantially to move outside of my sweet spot. Now, someone's asking if we ever use diagonal spreads instead of calendar spreads. The thing I want to point out is that the market tamer is a very flexible strategy, and there are multiple different variations of the market tamer. We do use diagonal spreads periodically with the market tamer, but the variation that I'm presenting to you today is, in our trading experience of trading this in the last 3 years, is the most consistently successful, best producing variation of the market tamer. So the calendar spread variation is the best performing. Diagonal spread variation works very well. Also, a little different dynamics to it, but they both work well. But what I'm proposing to you here is a single strategy focus, where we're really getting right down to the details of understanding a particular strategy. So time value decay is, on the short legs, is the primary driver of profits on the overall position. When a position is constructed properly, the credits on the short legs will provide for profits and will provide offset for slippage on the long legs. So that's why we like to get that big credit when we are selling the long legs, and we compare that credit to the overall debit that we experience when we're opening the position. Now, the direction of the movement doesn't matter, right? Once we open a market tamer, we've got both a call calendar spread and we've got a put calendar spread, so we don't really care if the index moves higher or lower. That forgiveness factor that's built into the calendar spread makes it ideal for non-directional market tamer, and we consider the market tamer to be a relatively simple strategy. Now, one other thing I just want to mention about diagonals, since somebody had asked about that, is diagonals are more expensive. Diagonals are going to make the cost of your market tamer much greater. The amount of credit that you get on the shorts, then as a percentage of the total risk, is going to be much smaller. So there are significantly different dynamics between that variation of the market tamer and the one I am presenting to you right here. So the market tamer as a single strategy approach to trading is something that we recommend. The market tamer is the type, and I'm going to say it this way, the calendar spread is actually the single strategy that you're trading. It's just that you're employing that calendar spread in the form of a market tamer. So you may decide that you want to either start trading options, you've not traded them before, you need a starting point, and calendar spreads are a great way for you to start. You may decide that you've been trading for a long time, you're not happy with your success, you're just kind of floundering all over the place, and you're not really achieving the level of success that you desire. I would say set aside the majority of everything you're doing and start simply. And whether it's with our strategy, our recommended strategy of a calendar spread, or it's a strategy that you prefer, whatever it is, if you adopt a single strategy approach, then you are going to start to really understand that strategy. And I find most traders don't really understand their strategies. They have a very loose kind of surface level knowledge of the strategy, but when it doesn't work out, they're confused, they bail out for a loss, and they don't really work the trade. There's not a discipline about working the trade and nurturing it across the finish line for a profit. Now, if you decided to adopt the calendar spread as your single strategy focus, and you did so by employing a market tamer, then what this market tamer will do for you is offer an opportunity to trade whether or not you are inexperienced or have a lot of experience. It really is available for all levels of traders as long as you understand the basic characteristics of options. If you understand the basic characteristics of expirations, strikes, time value, time decay, and delta, if you understand just those basics, then you can be very successful in trading the calendar spread variation of the market tamer. Now, the market tamer works well for a single position approach to trading also because it has a relatively short hold time, average of about 5 days. If you commit just 15 minutes per day to review your position, you can be very successful as a trader. You do not have to sit in front of your screen all day long watching tick by tick. What you do need to do is evaluate your position every single day. And what you would be looking at is, jump back to the position, you're going to look at the position and evaluate where is the index trading relative to my sweet spot. Am I in or outside of my sweet spot? How much time value remains in my short legs? How much slippage do I have on my long legs? I have an exit target. Let's just arbitrarily say my exit target was to exit out of this trade at $17. If my exit target is $17, how much of the time value needs to that remains needs to decay in order to get to my exit target? That's the evaluation you need to do. You do that on a daily basis, and you make decisions on a daily basis of whether or not there's action you need to take or whether or not the position is just going to be left alone for another day. If it's left alone for another day, you shut your computer off, you go about your life, you go back to your job, you go run your business, you go play golf, you go surf, you do whatever you do, and you go have a good time. You don't need to sit in front of your computer all day. I know it's about a 15-minute commitment because part of the service that we offer is an evaluation, a daily evaluation of the market tamer position. I do that evaluation personally every day. I break down the position, I analyze it, and we record it, and then I send that out to our subscribers so that they can understand exactly what I'm seeing on this position and whether or not there's action that would need to be taken. There's no significant charting or technical skills required in order to be successful with trading a market tamer. Now, if you're going to trade just the calendar spread variation, just the single directional calendar spread, although it has a forgiveness factor built in, you do need to have some understanding of how to read a chart and how to determine which direction the bias is of the market. But if you're trading the market tamer, there is no significant charting required, no significant technical skills required. And this is interesting. This was interesting as I was developing the strategy, over a couple-year period, to admit that we didn't really need to do any charting on this, because I'm a huge fan of charting. In fact, in my book that's coming out in 2 weeks, there's an entire section in there on technical charting and how to read the consensus of technical indicators. But what we were trying to do was to cater to people who were relatively new to trading and give them an opportunity to trade successfully without necessarily having to understand all the details of charting. So that's why the market tamer was originally developed. We also trade the indexes. This strategy has been traded on and can be traded on ETFs, most any stock, indexes. You can trade it on most anything. We isolate the majority of our market tamer trades to indexes, SPX, NDX, and RUT. I'm not talking about the ETFs, I'm talking about the indexes directly. So by trading the same indexes over and over and over again, and the one that we favor the most is NDX, then there's really no fundamental analysis that is required because you're not doing research on companies. The other reason we like to trade the indexes is they smooth out spikes that can happen from individual companies. When you're trading the NASDAQ 100, it's a weighted average of 100 different companies. If one company has sort of an announcement that causes the value of their stock to move more dramatically, it's evened out a bit in the indexes. So that's another reason why we like trading the indexes. And the market tamer, when we do make adjustments, really requires relatively simple adjustments. There's no significant management required to it. Sometimes there is more involved management, but in our programs we guide you through what that is. Most of the time we get to open a market tamer, wait for the time value to decay, close for somewhere between a 10 to 20% return, and then open a new market tamer. So the calendar spread market tamer strategy is an excellent way to get focused. And this is really where I want to summarize for you what I believe that focus can be. I keep looking for ways to really simplify. Keep looking for ways to allow people who have very active, busy lives that are apart from trading but have a love for trading, they can participate also. This is a single strategy approach. If you trade the same strategy over and over again, you will become very intimately associated with, acquainted with that strategy. You'll understand on a regular basis how that strategy responds under different market conditions. It simplifies your trading. When you have a greater degree of understanding, your level of confidence will most likely increase. I watch traders vacillate between euphoria and depression because of market movements. And that is not the way I want to live, and that's not the way I think that traders should live. If you develop a level of understanding that is truly that intimate understanding of this particular strategy and all of the different variations of it, then your level of confidence will increase. When you hear that the market has moved up significantly or has moved down significantly, you won't react anymore. What you're going to do instead is respond, and you're going to respond by taking the action that you know would be necessary to take. There's a huge difference in trading when you respond versus react. React is purely an emotion that you're really not in control. Responding is coming from a perspective of understanding, knowledge, and confidence, and you just respond to what is necessary in order to nurture that position along for a profit. Now, the other part of this is, aside from a single strategy, we propose that you trade a single position. If you trade a single position, only you have one position open at a time, first of all, most likely you won't have an excessive capital commitment that creates anxiety. Number two is it will decrease the amount of confusion you have. Having multiple positions open, especially when you have multiple different strategies in play at one time, can get to be overwhelming, especially when they aren't working out. And then you don't know what to do, and then you bail out, you lick your wounds, and some of you won't come back to trade anymore. If you focus on a single position along with a single strategy, it reduces your anxiety and it reduces your confusion, but it doesn't necessarily mean that you are sacrificing growth of your account. And I'm going to show you an example of what that could look like. Start small, but you could still possibly grow your account to a pretty healthy level. This whole approach eliminates worrying about market direction, and hopefully it lets you have more fun with your trading. So we have a program at Options Moneymaker that we offer, and it is designed to focus specifically on the calendar spread market tamer strategy. The calendar spread market tamer strategy. And we only trade one position at a time. So it is the strategy focus and the simplification of having a single position. This is called our Grow 20 education program. And this is an education program designed to teach you how to trade the strategy independently, not to make you dependent on somebody else. We want to infuse you with all of the knowledge we have about the market tamer so that after a period of time you would feel 100% confident being able to trade that strategy for the rest of your life. The way we offer this program is, it's called Grow 20, and we start with a capital account of $20,000. Now, we don't invest all of that $20,000 into a trade, and you as a trader should be wise about how much you have available to allocate to a program like this. If $20,000 is all you have, then you really have to think long and hard about whether or not you want to do that, because you should only invest capital that you could afford to lose. That by itself is going to either increase or decrease your level of anxiety. But that said, if you've decided to come to the game and you want to trade, allocate $20,000 of capital, we're not going to put that all in trades. We're not going to put it all at risk. We're ideally going to start with about 7,500 of the 20,000, and we're going to put that into our four-legged calendar spread market tamer position. The balance of the capital is reserved for adjustments when we need to do adjustments. Then we do a daily 15-minute position review. Like I said, I do a recording every single day doing a deep dive analysis of the position. Our intention then in this program is to take 50% of the profits that we generate from each position and allocate that into new positions. So essentially we're going to compound at a rate of 50%. Compound 50% of the profits that we are earning into future positions. Now, our win-loss ratio with a 3-year look-back period is 90%. We have a 90% win rate on these calendar spread market tamers. That's based on 3 years of live trades, not hypothetically back-tested, paper-traded trades. That's 3 years of live trades. And during that 3-year time period, we achieved a 12% average rate of return per position. We have losses along the way. We have gains along the way, and we net all of those together, and we ended up with an average rate of return of about 12%. And the average hold time on these positions is about 5 days. So let's take a look at what could possibly happen. Now, if we take those numbers and we project out, and I'm going to qualify this first of all by saying what all of you, I'm sure as traders, have heard before. Just because we've had great results in the past doesn't guarantee great results in the future. Or performance results of the past does not guarantee the same performance results in the future. So that aside, let's just think about a projection. What if we took those numbers and projected them out to the future? What could possibly happen with our small $20,000 account, focusing on a single strategy and a single position? Assume 12% return per position, because that's our 3-year run rate. Assume that we're going to lose 1 out of every 10 trades on an average, because that's our run rate. Assume that that 1 out of every 10 trades is about a 20% loss. Now, that's based on our run rate. That loss could be more, it could be less, but it's going to be about 1 out of every 10 trades if we assume the same run rate. And then assume compounding 50% of our accumulated profits into future trades. If you follow these assumptions here, and this is not intended to be a guarantee, this is not a certainty at all, but if you follow those assumptions, $20,000 has the potential to grow into just under $55,000 after 26 trades. It has the potential to grow into $144,000 after 52 trades, and it has the potential to grow into over $1 million after 104 trades. Now, let's look at this a little deeper. What if we did grow to $55,000, but it took 35 trades or 40 trades? I don't personally care. What if we did, in fact, grow to a 7-figure number, but it took 200 trades or 150 trades instead of 104 trades? Or what if it took 104 trades, but our average time in trade increased from 5 days to 10 days? There's all sorts of variables that you can assume in this projection. So this is not presented as any certainty. This is presented to say, this is a reasonableness test going forward if, in fact, we are able to achieve the same run rate that we achieved over a 3-year period. Ultimately, our objective of the Grow 20 program is to grow from 20,000 to a 7-figure number. That's our objective. How long that's going to take, well, we have some hints, we have some clues, but we don't know exactly. If it takes 2 years, then we're right on target. If it takes 3 or 4 years, well, it took longer, but guess what? We accomplished our objective. So ultimately, the objective is the 20,000 to the 7-figure number, not necessarily doing it in specifically 104 trades, specifically in 5 days per trade, okay? Sometimes traders get too hung up on the metrics and start losing sight of the big picture. And so this relates now to what I said at the beginning of the presentation about starting small, being patient, and just focusing on a single strategy and a single position. That's the offer that we have. That's what we're helping people achieve, and we're really just getting started with this. We consider this to be a very powerful way to start small and grow big. So the program that, and I would just want to highlight this for you, and then I'll take a look and see if there's some questions that I could answer for you. The program, the Grow 20 Market Tamer Education Program, is an education focused program. And what we provide to you is 10 hours of video instruction on the Market Tamer. Now you're going to learn different variations of the Market Tamer during those 10 hours of instruction. This is really intended to kind of seed your understanding of the Market Tamer. And then also included in that Market Tamer education package is a, there should be a line through that that 3. It's a 6-month free subscription to our alert service. So forget about the fact that it says 3 there. It's a 6-month subscription to the Grow 20 alert service. That includes the following: email alerts each time we open, close, or adjust a trade. Each time we open, close, or adjust a trade, we tell you what we are doing and exactly the specific steps, the strikes, and the expirations that we are using. So as you're learning, you could choose to follow along with us if you want to. I mean, there's certainly no harm in following along, even if you did it in a paper account, a virtual account, because included in the education program is 6 months of a free subscription, so you get to see the trades that we're placing. That 6-month free subscription also includes that daily position analysis that I talked about earlier. I record that, and then I send it out to you. And that ends up being your continuing education. Your continuing education, in my opinion, is the most valuable part of this entire process. So here we give you the seeds of the opportunity. We give you the 10 hours of just kind of basic overview instruction. But we don't abandon you there and say, hey, good luck. We taught you how to trade the market tamer and hope you can figure it out. Instead, what we give you is a daily commentary based on real-time market conditions. That daily commentary is going to come to you 5 days a week for 6 months, and it's about 15 minutes a day. Sometimes it's 20 minutes if I have a little more to talk about, but 15 to 20 minutes a day. This continuing education is designed to supplement your basic entry education to the market tamer. And after 6 months, then you could trade independently if you feel confident, or if you like participating in our Grow 20 alerts, we do offer a subscription after 6 months for $199. So the participation fee is just $1,495, $1,495. That's for the 10 hours and the 6 months of free subscription. If you're interested in participating, you can sign up directly at www.optionsmoneymaker.com/grow20. Now, if you're also interested in the book that will be coming out in 2 weeks called The Art of Trading More Profits in Less Time, you can shoot me an email, markd@optionsmoneymaker.com. And certainly, if you have other questions about the market tamer strategy or about Options Moneymaker, you can email me at that address also. So let me go see what kind of questions there might be here. Hold on. Scroll through some of these. I think I answered some of them as we went. Is it in a way similar to straddles? Benny's asking, is the market tamer in a way similar to straddles? There is some similarity, but straddle is really a different position. The dynamics of the legs in a straddle will work differently than in a market tamer, but yeah, there is some similarity. Lori's asking, do you put both of the calendar spreads, both the call and the put calendar spreads on simultaneously? Typically, yes, we do. We open them both at the same time. That helps us align the delta value of the long put and the delta value of the long call, so we have a nice balanced position. TJ is asking, are the shorts spaced evenly from each other? No, not necessarily. The strikes are selected based on the delta value, and that will help us determine, that's going to determine how far from the money, out of the money, each side is. What usually happens, TJ, is that the call strikes are closer to the money than the put strikes. Put strikes typically have more premium in them. Let's see here. How long are you running the Grow 20 live? The Grow 20 is going to be a program that's going to be in place. We intended for it to be in place for quite a while. As I said, ultimately our objective is to grow from 20 to a 7-figure number. We think that's going to take a couple, 3 years to accomplish. There's a lot of opportunity along the way to significantly learn how to open these trades, understand how they respond to different market conditions. So we plan on it being around for a while. TJ's asking, what's the name of the book? My book's coming out in 2 weeks. It's called The Art of Trading More Profits in Less Time. David's asking, do you have a client that made that kind of money during the 3 years you're running with live trades? David, we did not promote this type of trading for the 3 years. We were doing live trading in our own accounts. We were really finalizing. I'm not saying finalizing. We were really fine-tuning the whole strategy, and we were trading variations of the market tamer strategy as a way of really honing in on which variation was the most successful and would produce the best results. And it was only after we felt confident that we had some good, solid data on that we started offering the Grow 20 program. And we've really just started offering it. It's a brand new program, so we're just getting started with it. After 6 months, what's the cost of the Grow 20 Alert subscription service? That's $199. Had an opportunity over 3 years to have the chance to grow 20 accounts into 1 million account. Given the results you've claimed, did anyone achieve the results? I think I just answered that. We were doing a lot of testing over that 3-year period, trading those in our accounts. We were fine-tuning the parameters. We were comparing different variations of the market tamer. And then finally we isolated down to the calendar spread market tamer. So it's kind of going forward that now we are focused exclusively on the calendar spread variation of the market tamer, and we will see going forward whether or not we can produce the same results we did with that strategy over the last 3 years. We don't know that yet, but we're going to have fun finding out. What is the cost of the book? Chuck is asking what the cost of the book is. The book is going to have a very short-term promotion to it. We're practically going to give away the book for probably 24 to 72 hours, and we'll be advising what the price of that is once we release it. We're still trying to determine that, but it's not going to be expensive. Can you please answer Ron's question? Just answered that. And let's see here. Broker recommendation. Fred, we do all of our trading with Trade Monster. We think they have an outstanding trade platform. They allow a lot of flexibility in being able to set up these trades. You can set it up as a 4-legged trade and open and close it. So we like Trade Monster, but you can trade it at most any trading firm. Does your book cover the market tamer strategy? Yes, it does. It covers it covers multiple variations. It's not isolated just to the calendar spread strategy, but it does give you a good overview of the market tamer. Do you specify the details for the calendar spread in your book? Yes, we talk about that. David's saying thank you. Did your own account accomplish that goal? I just want to, Tim is asking that. I just want to emphasize again, we were not specifically focused on this one isolated trading strategy. So we spent the 3 years accumulating data, and it is now that we've kind of started at the starting line and we're going to move forward. And that's why I said that I can't guarantee that going forward we're going to achieve the same results. What I know is, looking back, if I take a look at the number of trades that we did and the averages, and I compare that to the other variations of the market tamer strategy, we can project that forward, and it gives us a reasonable projection to go from 20,000 to a 7-figure account. Whether or not we actually achieve that goal will be up to us and how we handle these trades on a daily basis. And whether or not we achieve that goal in a time frame that would be satisfactory to you. to me, frankly, if it takes me 5 years to achieve that, I don't really care, because what I'm going to see along the way is that I'm making steady progress. And perhaps my averages change from what they were with my 3-year history, but it really doesn't matter to me. At this point, we take that projection, we fold it up, we put it in a drawer. We don't focus on that. We focus on the trade that we have in front of us every day. And if we can nurture each trade along over the finish line with a profit, then we know that we're making progress one step at a time. Ken is asking, can I do the market tamer in an IRA account? I will say yes, but I know that there are some brokers that may not allow you to do that. Trade Monster does not happen to be one of those brokers, so you can trade an IRA, market tamer in an IRA at Trade Monster. Another advantage that we've found over the years of trading with Trade Monster. TJ's asking, what's more important, getting into a good trade or managing it? Well, the simple answer, TJ, is if you get into a good trade, you most likely won't have to manage it. There's going to be fewer trades that you end up having to manage. So we like to get into a good trade, and we construct our trades using the same guidelines and parameters. We construct our market tamer trades by opening long legs that have a 30 to 35 delta. We open the corresponding short legs, and then if the market moves more dramatically, we may end up having to manage it. And we manage, and our triggers to manage are very simple also. When it moves outside the sweet spot, we take some management action, and it's pretty simple management that we take. That's the answer. We're not opposed to managing, but we prefer to construct our trades in a way that we can avoid it if at all possible. Chris is asking, do you have a signal service without Grow 20? I'm not sure I understand that question, Chris. I don't know what a signal service is without Grow 20. Fred's asking, can I set up Grow 20 with less than $20,000? Absolutely. We have some clients who have started with much less than that, and we have clients who have started with much more than that. We're using 20,000 as kind of a guideline, because then we know opening 3 or 4 contracts, gets us into a very comfortable range in terms of the amount of capital that we've allocated. But say, for example, if we specified a 4-contract trade and you wanted to trade less than $20,000, you could modify the number of contracts and still follow along with the exact same trade, but you can just proportionately decrease the number of contracts. John says, I've been following you for about 6 months and have learned a lot. Thank you, John. Really appreciate that. How do you manage it, buy it back, and roll it out? All right, I'm just about out of time, but let me just take that question, and I'm going to give you a simple version of the management. This is overly simplistic, and it's not intended to give you all the instructions on what to do. But let's take our example trade where we were in the 42.25 call calendar spreads. And let's say the index moved higher and we found ourselves with the index trading at 42.40. It's now outside the sweet spot. We're more than likely going to have a profit on that call calendar spread. And we still have time value remaining in the short put. So we still have some forgiveness factor built into that short put. The simple answer is when we're outside the sweet spot, we're going to close that call spread. We're going to close the spread that has been encroached on, and we're going to reopen a new call spread using the same expirations, but placing the strikes out of the money. We want to try to maintain our strikes out of the money as much as possible. So that's a simple answer on what we would do. We would sell to close the current call spread and buy to open a new call spread, placing it further out of the money, taking a profit as we close the call spread, and opening up additional time value in the position by opening the new spread. And there are other steps that we may or may not consider taking in that management and adjustment also, which would be a little bit too involved to get into here, but we go through those on a daily basis. We'll go through those on a daily basis in the analysis when we're executing those moves. Well, I've got about 5 minutes left. I don't see any other questions. So let me just take this opportunity to summarize for you. First of all, thank you so much for the questions. Thank you for your interest in what we're doing. I really enjoy what I do. I love teaching people how to trade. Trading is one of those pastimes, whether it's a profession or a hobby. Trading is one of those things that can be very cruel to you, especially if you don't really understand what you're doing, but it can be a lot of fun. One of the main reasons I love trading, I'll just put a bit out there for you to think about, is trading in my life has given me complete lifestyle freedom. I get to live where I want, I get to travel as often as I want, I get to stay for as long as I want, and as long as I have a internet connection, I can trade. So that's why I love trading, and I also love helping other people learn something that they have a passion for doing. I'm not a hard sell person. I don't go pounding on doors looking for people to put into my programs. But if people have a passion for trading and they're looking for an opportunity, I just like to share with you what this opportunity is, because I think it's a pretty great opportunity. And we provide a lot of support in teaching you how to do it. So if you're interested in the Grow 20 program, we have it available for $14.95, and you'll get 6 months of trade alerts free if you sign up for that. So my book's coming out in 2 weeks. It's going to be the first of 3 books that'll be coming out in the next few months. We'll also have one coming out on different variations of spreads, credit spreads, and how to properly be trading those. So again, I appreciate Trading Pub hosting me. I appreciate your time here today, and if I can answer any questions for you after today, just email me at markd@optionsmoneymaker.com.
Okay, well, thank you, Mark, for that terrific and thorough presentation on how Market Tamer can be used to trade calendar credit spreads in the options market. I really like the fact that you emphasize this many times, that you don't really have to worry about market direction, and with patience and with focus, it's possible that a small account can grow big, and it looks like a very low-risk way of achieving regular and consistent account growth. I also want to thank you for that comprehensive offer you put together for our members on the Grow 20 Market Tamer education program, which includes that bonus 6 months of free trade alerts. And I think we all look forward